Advanced capital budgeting. Capital budgeting is a technique used for evaluating long-term investment proposals. In capital budgeting, there are two types of techniques used: non-discounted cash flow technique, discounted cash flow technique. Non-discounted cash flow technique. Following techniques are used in case of non-discounted cash flow techniques: payback period, accounting or average rate of return. Discounted techniques: discounting payback period, NPV, net present value, profitability index, IRR, internal rate of return. Cash flow after tax equals to NOPAT plus depreciation. Terminal value equals to residual value minus tax. If a rate of depreciation is given, salvage value is never deducted. If depreciation rate is given, salvage value is never deducted. Lower payback period is better. Payback period format: year, cash flow after tax, cumulative cash flow after tax. Accounting rate of return or average rate of return equals to average PAT divided by initial investment into 100. Higher accounting rate of return or average rate of return is better. Next, NPV. NPV equals to present value of cash inflows minus present value of cash outflows. Positive NPV is better. Profitability index. Profitability index equals to present value of cash inflows divided by present value of cash outflows. Profitability index, if it is greater than or equals to 1, it is better. Equivalent NPV per annum. Equivalent NPV per annum equals to NPV divided by present value annuity factor. If life of two projects are unequal, calculate equivalent NPV per annum to take the decision. If life of two projects are unequal. Next, at IRR, NPV equals to 0, that equals to present value of cash inflows equals to present value of cash outflows. At IRR, profitability index is 1. Higher IRR is better. In case of single project, NPV decision is directly proportional to IRR decision. Inflation in capital budgeting. Inflation in capital budgeting. Cash flows are of two types: real cash flows, nominal or money cash flows. Real cash flows means they are without inflation. Nominal or money cash flows means with inflation. Nominal cash flow equals to real cash flow into 1 plus r whole to the power n. Discounted cash flows. Discounted cash flows contains no risk, no inflation. Here, real cash flows contains risk. Nominal or money cash flows are with inflation and with risk. Next, cost of capitals. Cost of capitals are of two types: real cost of capital, nominal or money cost of capital. Real cost of capital means without inflation. Nominal or money cash cost of capital means with inflation. Inflation rate or inflation cost of capital is also there. Third type of cost of capital, inflation cost of capital. Inflation cost of capital means with inflation, it is nothing but a nominal or money cost of capital. To remove inflation, we need to divide. To include inflation, we need to multiply. To remove, divide, include, multiply. Nominal discounting rate equals to 1 plus a real discounting rate into 1 plus inflation minus 1 whole into 100. Real cash flows should be discounted with real discounting rate. Nominal cash flows should be discounted with nominal discounting rate. Next concept, risk analysis in capital budgeting. Statistical techniques. Here we calculate standard deviation and coefficient of variation, that is CV, to find out the risk. Following are the steps. Step 1, calculate expected NPV, that is x bar equals to summation of P into X. Step 2, calculate standard deviation. Sigma x equals to square root of summation of x minus x bar whole square into P. Step 3, calculate CV, coefficient of variation. CV equals to sigma divided by x bar. Higher CV means higher risk. Next, conventional techniques. First one, RADR. RADR means risk adjusted discounting rate. Following are the steps. First, step 1, calculate RADR, risk adjusted discounting rate. RADR equals to RF plus risk premium. In case the business is same, if the business is different, that means other business, RADR equals to RF plus risk premium into risk index. Or we need to calculate RADR depending upon CV, coefficient of variation. Higher CV, then higher RADR need to be taken. Step 2, calculate NPV using RADR as discounting rate. If question is silent, assume cash flows given are cash flows after tax. That is, we need to ignore tax. Next, certainty equivalent. Certainty equivalent steps. Step 1, calculate risk-free cash flows. Risk-free cash flows equals to expected cash flows into certainty equivalent. Step 2, calculate NPV using risk-free as risk-free rate of return as a discounting rate. Low certainty equivalent means higher risky. We need to use high RDR. In case of high certainty equivalent, that means low risky, low RDR need to be used. Next, sensitivity analysis. Sensitivity in cost of project equals to NPV divided by cost of project into 100. Sensitivity in CFAT equals to NPV divided by present value of CFAT. Sensitivity analysis means analysis of various variables of the project like cost of the project, selling price of the project, selling price of the product, cost of the product, life of the project, cost of capital, etc. Here we change each factor in unfavorable direction, keeping other factors constant to find out the critical factor so that further research may carry out about such factor before accepting the project. Sensitivity in cost of capital equals to IRR minus cost of capital divided by cost of capital into 100. At IRR, present value of cash inflows equals to present value of cash outflows. Present value of cash inflows equals to annual cash inflows into present value annuity factor at the rate of cost of capital for n years. Present value cost outflow equals to annual cash flow after tax into present value annuity factor at the rate of IRR for n years. Present value cost of capital, present value cash outflows means cost of the project. Sensitivity in fixed cost equals to NPV divided by present value of fixed cost into 100. Present value of fixed cost equals to annual fixed cost into present value annuity factor at the rate of cost of capital for n years. Break-even point in units equals to fixed cost divided by contribution per unit. If acceptable level of risk is not given, accept project based on expected NPV. Equivalent annual present value cash outflows equals to present value cash outflows divided by present value annuity factor. Next, scenario analysis. Here, we change all the factors of the project simultaneously and calculate NPV in different scenarios. Next, replacement decisions. In case of replacement decisions, decision will be taken on the basis of incremental cash flows. Here, replacement decision will be done to decide whether to replace the machine and when to replace the machine. Mainly, it is done to decide when to replace the machine. Next, equated annual installment equals to loan amount divided by present value annuity factor. Return on investment equals to EBIT divided by interest into 100. Return on equity equals to earnings available to equity shareholders divided by equity shareholder funds into 100. Return on equity equals to return on investment plus return on investment minus KD into debt by equity. Project IRR. It is just like a return on investment and it is calculated for both debt and equity. Equity IRR. It is just like a return on equity. It is calculated for equity only. Equity IRR equals to project IRR plus project IRR minus KD into debt by equity. Hedge model and Hillier model. Hedge model and Hillier model. Here we calculate standard deviation of NPV. Here cash flows are of two types: dependent cash flows, independent cash flows. Independent cash flows means cash flows are same, probability is same. In such a case, that cash flows will be considered as independent cash flows. Hedge model is used to calculate standard deviation of NPV when cash flows are perfectly dependent. In case of hedge model, standard deviation of NPV equals to standard deviation of cash flow for first year divided by 1 plus R whole to the power 1 plus standard deviation of cash flow for second year divided by 1 plus R whole square plus standard deviation of cash flow for third year divided by 1 plus R whole to the power 3. Hillier model is used to calculate standard deviation of NPV when cash flows are independent. Sigma NPV, standard deviation of NPV equals to square root of sigma cash flow square divided by 1 plus r square 1 plus r square plus sigma cash flow square divided by 1 plus r whole to the power 4. Sigma NPV equals to square root of sigma cash flow square divided by 1 plus r whole square plus sigma cash flow square divided by 1 plus r whole to the power 4. If question is silent, assume independent cash flows. That means use Hillier model for calculating standard deviation of NPV. Standard deviation is a measurement of risk. If two projects having same NPV, we select project having lower standard deviation. In case of conflict, if project A has higher NPV and project B has lower standard deviation, then decision will be taken based on CV, coefficient of variation. CV equals to sigma divided by x bar. Lower CV means lower risk. Next, decision tree analysis. It is used in case of interdependent variables. Here, models are of two types: joint probability model, cumulative with joint probability model. In case of joint probability model, total of joint probability equals to 0. In case of cumulative with joint probability model, total of cumulative probabilities are not equals to 1. Decision tree is used when outcome is uncertain or outcome of one stage influences other stage. Outcome is uncertain means here cash flows are doubtful, not volume is doubtful. A rectangle is considered as a decision node and a circle is considered as chance node in case of decision tree. Next, whether to use cumulative or joint. Whether the probability is cumulative probability or joint probability. How do you know that? If in the question R is given, it increases the probability. So we need to add it, then we use cumulative probability. If in the question N is given, it decreases the probability, we need to multiply it, we use joint probability. Next, simulation. Simulation means random choices. Monte Carlo brought single-digit random numbers and double-digit random numbers. In case of simulation, simulation starts with 0. Other important points: in capital budgeting, simple averages are not taken. Simple averages are used for past information only. On depreciation, inflation rate is not considered.